So if you track the news, even, just casually, you've probably seen those headlines about global commodity prices easing and maybe felt a little bit of relief, right? Cheaper gas, maybe lower food costs down the line. But if you really scratch beneath the surface, the latest market snapshot from December 2025, it reveals a much more complicated and frankly fraught picture for the global economy.
Oh, it's not as complicated. It's a picture of micro chaos set against this massive, deep downward trend. I mean, you look at the raw data and it's all over the map. European natural gas, for instance, it dropped a healthy 4.3% in November. Great. But at the same time, Australian coal prices shot up 4.7%,
And food prices were up too, right?
up 2.4%, while raw industrial materials actually declined 1.1%. Yeah, chaotic.
So we're seeing all this chaos in the micro data points, but if we pull back, the central conflict for you, the listener, is really clear. Sustained low commodity prices, they signal a potentially destabilizing economic challenge for the producers and exporters who actually, fuel global trade.
Exactly. And the stakes are incredibly high for emerging market economies right now. If a producer in, say, Asia or Africa can't sell their goods at a viable price, they can't service their debt, they can't pay their workers, and they suddenly become the weakest link in a global supply chain that, well, the rest of the world relies on.
And that is the mission of this deep dive. We are jumping into the World Bank Group's latest outlook for 2026, which paints a pretty stark picture of sustained decline. And then we're going to uncover this ingenious financial tool the International Finance Corporation, the IFC, is using to keep these vulnerable suppliers afloat and, crucially, to incentivize them towards sustainability while they're at it.
Yeah, the big picture is that this recent era of extreme short-term volatility, it's giving way to a new dynamic, a multi-year sustained price decline that is changing the structural balance of the entire global economy. Okay, let's unpack this.
Let's do it. Where do we start?
Well, the World Bank Group's Commodity Markets Outlook, which came out in October 2025, it delivered a really stark forecast. They're projecting that global commodity prices will fall to their lowest level in 6 years, by 2026.
6 years. And this isn't just a blip. You said this is the fourth consecutive year of decline?
The fourth. And they forecast prices to drop by 7% in both 2025 and 2026. So that's a serious structural headwind across the board.
Okay, if the market is signaling this kind of prolonged weakness, what are the fundamental forces driving this broad downturn across energy, metals, and agriculture?
There's weak global economic growth and, persistent policy uncertainty. Those are key factors, of course. But the main story, particularly in the energy complex, is the massive oil surplus, what people are calling the oil glut. Oil prices have been averaging around $65 a barrel for the past quarter. That puts enormous pressure on energy exporters.
So if prices are that low, the market's telling us supply is just overwhelming demand. Let's look at the supply side first. Where is all this plentiful oil coming from?
It's really a three-part answer. First, the resilience of the United States shale oil industry. It just continues to surprise everyone. They are supplying consistent, high volumes.
Okay, one.
Second, Russia. Despite, comprehensive international sanctions and restrictions, it has successfully rerouted its exports. It's maintained a remarkably steady flow onto the global market.
And the third part, I'm guessing it has something to do with OPEC Plus?
Absolutely. Throughout 2023 and 2024, OPEC Plus had implicated pretty significant production cuts to try and stabilize prices. But late in 2025, they decided to remove those cuts, essentially flooding the market with additional supply at the exact moment the global demand picture was weakening.
So if supply is that ample, what specifically is happening on the demand side that's compounding this glut, especially in a major market like China?
This is where it gets really interesting because the demand weakness isn't just cyclical, it's structural. China is undergoing this massive overhaul of its transportation industry, specifically targeting fossil fuels. We're seeing electric vehicles account for up to 50% of new passenger cars sold there. That means vast amounts of gasoline demand have been, permanently curtailed.
That transition alone is enormous. But I remember seeing something about the trucking industry also shifting away from traditional diesel.
That's the critical secondary pressure. Most new heavy-duty trucks sold in China are shifting from diesel engines to running on natural gas. This change signals that even if global growth were a bust, the peak demand for certain fossil fuels, specifically oil, may have permanently passed.
So it's a perfect storm. Supply is high from three different sources, and demand is structurally weakening.
Exactly. This dual-pronged scenario is why the World Bank is forecasting such a persistent surplus and consequently a 4-year decline.
However, you said it's not a uniform plunge. This is where we need to look closer. Base metals are stable, grains are under pressure, but then you have these major exceptions that seem to be defying gravity.
We certainly do. Grains are under pressure because high supplies are expected globally, which is, I guess, good for global food security. Base metals, used in construction and electronics, they're broadly balanced, so they're stable. But here's where it gets really interesting. Gold is trading above $4,000 per troy ounce.
Reflecting all that global uncertainty.
Precisely. And then there are those tropical crops, which are vital for so many small emerging economies. Tropical commodities like coffee and cocoa are seeing steep price increases, driven almost entirely by climate change concerns affecting tree crops and supply reliability.
And what about fertilizers? I remember that being an outlier.
A big one. We're seeing upward pressure on fertilizers. And that reflects specific trade restrictions put in place by China, which is exporting far less fertilizer than it used to. That causes localized shortages and price hikes everywhere else. So while the macro trend is down, those exceptions are vital for understanding who's struggling and who's, actually benefiting.
Okay, so now we pivot to the consequences of this long-term sustained price decline. While you and I might cheer at the gas pump, low prices absolutely crush the margins of producers and exporters. This is where the core tension lies, right? It quickly boils down to a desperate liquidity crisis for these crucial links in the supply chain.
That's the existential challenge. The producers, who are often in emerging markets, they're the engines of global trade. And when their margins are pressured, their ability to get the financing they need to bridge the gap between production and payment their working capital, it just dries up immediately.
Let's try an analogy to explain this because it feels a little counterintuitive. When commodity prices are high, exporters actually need more financing because the inventory they're holding is just more valuable, right? So they need a bigger loan to cover that working capital gap until the buyer pays.
Exactly. But when prices are low, like the forecast for 2026, their margins are just crushed, especially for the smaller suppliers. Their immediate financial health becomes so much risky in the eyes of traditional lenders.
So they need the financing more desperately just to cover basic operations, payroll, bills, but it's harder to get.
That's the paradox. It's harder to secure because their sales revenue is lower, and they just look like a big credit risk.
It's genuinely counterintuitive, isn't it? The sources note that these smaller suppliers actually use a higher share of financing facilities relative to their sales during these low price periods.
That's the point. They aren't using this financing to grow. They're using every single dollar just to cover basic payroll and utilities. This financing stops being growth capital and becomes a true operational lifeline.
Which raises the big question, how do global institutions step in to stabilize these crucial links when the market is pulling back? If these exporters fail, the entire global supply chain is at risk.
That's the systemic risk.
And this is where the International Finance Corporation, the IFC, member of the World Bank Group, enters the picture. They come in with their innovative solution, the Global Trade Supplier Finance Program, or GTSF. It's a $1 billion short-term lending facility designed specifically to create stronger, more resilient supply chains by addressing this very liquidity gap.
And the core mechanism of GTSF is what makes this so powerful. It provides affordable, short-term working capital by purchasing and discounting invoices that have already been accepted for payment by pre-approved, often investment-grade global buyers.
Okay, so the IFC is effectively de-risking the small supplier. They're using the massive manufacturer's superior credit score as the safety net. They're lending based on the credit rating of the reliable buyer, like a major global retailer, rather than the struggling small supplier.
Precisely. And the benefit for the supplier is manifold. They get immediate cash conversion from their sales receivables, turning, say, a 60-day payment term into immediate working capital. They get access to lower-cost financing without the collateral that they probably couldn't provide anyway. It really levels the playing field.
And the scale of this operation shows just how vital it is. The GTSF program dispersed, $18.6 billion between 2012 and 2025 to over 2,500 suppliers across 33 countries. What stands out to me is the focus. 60% of the disbursements in fiscal year 2025 went to suppliers in the world's poorest countries. That is targeted resilience building.
It is. But what's really fascinating here is that the financing isn't just cheap, it's tiered. And it's directly linked to sustainability performance. It makes the program an engine for ESG improvement across these supply chains. It's financial engineering with a moral and commercial compass.
How exactly do those tiered rates work in practice? How do they motivate genuine change in a supplier's behavior?
Well, the IFC partners with global buyers who themselves have specific measurable targets, things related to decarbonization, resource efficiency, or social standards. The financing starts at a competitive rate, but then the supplier earns a progressively lower interest rate. or a higher discount on their receivables as they reach pre-agreed sustainability milestones.
So the better you are for the environment or for your workers, the cheaper your money is. On a continuous basis, that is a truly powerful incentive because it hits their bottom line directly with every single transaction.
It is. And this isn't charity, it is sound commercial strategy. The data reflects the success. 73% of disbursements in FY 2025 were in these sustainability-linked facilities. It's rapidly becoming the standard.
Okay, let's use a concrete example to make this stick. The IFC has partnered with the major Globin chocolate supplier Barry Callebaut in the sugar sector. Walk us through how that works for, say, a sugar farm.
Right. So a sugar supplier works to achieve certification levels, like Bonsuco, which verifies sustainably and responsibly grown sugar. As that supplier improves their Bonsuco certification level, proving better social or environmental practices, the interest rates on the working capital they receive progressively go down. The genius is that this incentive is continuous. It affects every single export ship that they make. It's built right into the transaction flow.
And the IFC understands you can't just offer a carrot. You have to teach them how to get there. They pair these financial incentives with deep advisory services.
That's crucial. Many small suppliers just don't have the technical expertise or the capital to implement advanced decarbonization or gender equality protocols on their own. So services like the Partnership for Cleaner Textile or PCT and Gender Equality in Returns or GER, they provide the technical assistance needed to help those suppliers actually meet those demanding goals. It's financing plus capability building.
Shifting gears slightly, let's look at the winners and losers in this fragmented environment. Despite sluggish global growth overall, emerging market and developing economies, EMDs, are expected to grow much faster than advanced economies, which means they remain central to commodity demand and the global trade system.
That structural growth difference creates regional winners based on their commodity exposure. Latin America, for example, is a major beneficiary on the agricultural and grain side. We saw Brazil step in to feed that massive soybean gap created when China restricted imports from the U.S.
So trade friction can create winners, not just losers. What about on the energy side?
On the energy side, North America, specifically the U.S., is a big winner. That's because of the structural shift toward liquefied natural gas, or LNG, exports. Replacing traditional pipeline connections, particular to Europe, this has created a persistent demand floor for U.S. gas.
And which regions in the developing world are seeing specific sectoral boosts?
Africa is benefiting in a few key sectors. On the metal side, exporting base metals and critical materials needed for the energy transition. And sub-Saharan Africa is seeing strong benefit from the high prices of tropical commodities like coffee and cocoa, which, as we noted, are defying that downward trend because of climate stress.
Okay, finally, we have to address this persistent risk of trade friction, sanctions, restrictions, weather events. How are these forces permanently fragmenting global trade and impacting prices in the long run?
Well, these trade frictions, they create significant dislocation in the short term. They cause price pressure where supply is restricted. However, our experience shows these dislocations typically fade within about 4 to 6 months. New trade arrangements form, new buyers or suppliers step in.
But the friction leaves a lasting scar, right? It sounds like we aren't just going back to the way things were.
We are not. While the short-term crisis fades, the sources note that trade routes are now permanently less efficient than they were before the friction. This isn't talk about longer shipping routes. It means higher insurance costs, increased geopolitical risk pricing, and it requires businesses to implement dual sourcing strategies. All of that bakes new, systemic inefficiency into the global cost structure.
So what does this all mean for commercial resilience in this new, less efficient, high-friction world?
Resilience requires flexibility. The sustained price decline pressures margins, and trade friction raises long-term costs. The IFC is helping global buyers adjust their strategies, whether that's nearshoring or removing geopolitical risk, by bringing new, vetted suppliers into flexible, affordable financing programs like GTSF. It ensures that those crucial supply links remain operational and adaptable, even during a commodity price plunge.
So, to recap, we've navigated a 4-year commodity price plunge, driven largely by the massive oil glut and weakening global demand. We understood the subsequent liquidity squeeze that makes financing a desperate lifeline for these vulnerable exporters. And we've showcased the IFC's two-pronged solution, low-cost financing linked directly to sustainability goals through these tiered interest rates.
The key takeaway really is the mechanism of resilience. The source material highlights that while trade frictions are temporary in their acute phase, they cause long-term inefficiency, and that leads to higher baseline global prices overall.
So here's a final thought for you to mull over. If the hidden structural cost of maintaining resilient, friction-free supply chains is actually higher overall global prices due to this systemic inefficiency, does the financial benefit of sustainability-linked finance, like GTSF, become not just a good thing to do for the planet, but an absolute commercial necessity for survival in this new fragmented global economy?
A fascinating point for commercial consideration and adaptation. Thank you for sharing your sources with us.
It was a pleasure to delve into the data. We'll see you next time on the deep dive.